Good morning, everyone. Welcome to the Fisdom Wealthcast. This Wealthcast is titled Wise Decisions, and very soon you are going to know why do we call it Wise Decisions. So, just as a genesis, today there is no dearth of data, right? There's a lot of data floating around on the internet, and at the same time, there are a few wise people who process that data into information, and then there are a set of wiser people who use that information to develop insights. Now, after processing data into information and information into insights comes the most important utility of data, information, or insights, that is decision. So today with us we have a seasoned veteran and a guest who is known around the industry as a great decision maker, who is known for his wise decisions. With us today we have Mr. Taher Badshah. So Taher has over 26 years of experience in the Indian equity markets. Today, he serves as the Chief Investment Officer Equities for Invesco Mutual Fund, which is amongst the rising asset management companies in India. So Tahir is mainly responsible for overseeing the equity investment strategies of Invesco Mutual Fund. Tahir joins Invesco Asset Management from Motilal Oswal Asset Management. Over there as well, he used to be the head of equities. So, Tahir, a very warm welcome to our Wealthcast. It's a true pleasure to host you on our Wealthcast. Hope you're doing well.
Thank you. Thanks very much, Nirav, for that introduction, and thank you, Fisdom, for hosting me. I'm well. I hope you guys are doing well too and taking good care of yourselves. And I wish the same for the audience as well. Uh, Thank you very much.
Thank you. Without any further ado, I've been trying to contain my excitement. There's a lot that I want to know about, and like the series talks about, it's all about wise decisions. And while thinking about, rather while interacting with investors, there have been a couple of data points that have come forth, and there are a couple of information pieces that somehow may or may not add up, and which makes it really difficult for investors to interpret such information. So I'm just going to present a few dilemmas. I'm going to present a few facts and data, and let's see how do you take a reading on those pieces of information. So right at the outset, let's talk about the most important thing that everyone's talking about today: the economy. All right. So media is abuzz with headlines about the economy. All right. Almost every news publication has an opinion of its own, and almost every market pundit is making some huge comments on how the economy is shaping up. I've always gone through the entire alphabet soup of recovery. I've heard of almost every alphabet imaginable in to reflect the kind of recovery that we're staring at. But at the same time, the media made quite a buzz of the headlines wherein the real GDP quarterly growth fell by almost a negative 23.9%. This minus 23.9% was actually blown out. Maybe or maybe not, but out of proportion. Right? At the same time, in its recent policy minutes, RBI also spoke about us being technically closer to a recessionary phase. I mean, we cannot rule that possibility out, and the FY21 is going to see a contraction of almost the GDP contraction of almost negative 9.5%. Okay, so these are the gloomy bits of news. But at the same time, I also read that the GST collections are almost at par with pre-COVID levels. I've also read that consumption is picking up. I've also read that the reforms that the government is taking in terms of stimulus and policy reforms, they're actually bearing fruit. There are initial signs of recovery that is actually visible. And in the same RBI minutes where it warned of a contraction, it also promised of a positive GDP in beginning the fourth quarter of FY21. So these are two starkly different, pieces of information which we may or may not know how to stitch together. So what's your reading on it? How do you see our economy shaping up, and how do you think investors perceive the current state of economics?
So, good afternoon once again. And what you referred to probably is a combination of what some of it is a little more hindsighted or probably backward looking, and some of it which is probably a little more forward looking and uh, what is likely in store going forward. So, when you look at the 24% negative number on the GDP print, Of course, that's the historical number for the June quarter. And when the RBI recently, in its credit policy, along with for the first time, they actually highlighted. Sorry, I'm getting an echo. Is that
No, I can hear you. There's no echo here.
all right? Okay. So basically, when the RBI recently put out a growth number for the as a first time after the pandemic about the GDP forecast for FY21, they stated a number of 9.5% for the year as a whole. Now, if you were to take the first quarter, which was down 24%, and if you attribute one fourth of the weightage to that number, so it's a -6% odd contribution, which out of that -9% will come out of that first quarter itself, if we were to aggregate it for the year as a whole, which essentially means that what RBI is talking about is actually another 3 to 3.5% for the balance 3 quarters of the year, in implied within which or embedded within which is actually probably an assumption that hopefully by the end of the third quarter in December. I think they specifically highlighted that the positive number of growth in GDP will only be seen by the fourth quarter of FY21, which therefore also tells you that for the balance 3 quarters of the year, you're essentially looking at an aggregate contraction of another 3%, because out of the 9%, 6% odd is already being contributed by the first quarter, which basically means that you are going to be in an upward trend implicitly implied within that guidance. And probably you may hit a small positive or a break even kind of a number by the third quarter, and possibly a nice, decent positive number by the fourth quarter. So even within the RBI's own data. What I'm trying to say is that there is an embedded uh, improvement in the economic structure going forward, and it's not very surprising. I mean, given the fact that the economy after that very sharp contraction as a result of the lockdown is gradually on the way up and on the way of actually unlocking. Now we have still not entirely unlocked, even though we all have started to kind of move around a little more than what we used to. But there are good sections of the economy which are still kind of held up, especially in the urban centers. While the tier two, tier three centers are probably doing well, and I would like to think that they are still strong enough to continue on that path. But the urban centers, even in let's say the September quarter, the quarter that has gone by, is not fully up on its feet. I mean, there are parts of uh, all these major metros, Mumbai, whether it is if you take Delhi or Hyderabad, and all these places are still under reasonable amount of lockdown. And I think they're still likely to. They're probably, in my view, operating in more like two-thirds of the potential, if at all. So there is a strong amount of latent recovery which can come about as and when the urban centers start doing a little better, or they start opening up entirely. We don't have many of the rail services, for example, the metropolitan rail services in Mumbai itself are still not opened up. So we can imagine the kind of part of the economy which is still not fully functional. So I think that itself may bring in a lot more acceleration. I think going forward. So I would like to say that more or less, if not in the next couple of months, by the end of this calendar year, I have a feeling that we will probably be back to where we were in January, February of last year, of this year. So by and large, after a gap of more or less about 12 months, we will probably be trending in approximately the same level as where we were, at the start of the year.
Right, right. Makes a whole lot of sense. It completely adds up. I feel the point was made right at the outset. When you mentioned that some of the data that people are still talking about is hindsighted, and obviously you cannot drive a car looking into the rearview mirror. It sounds cliched, but is very much applicable even today, right? So makes a whole lot of sense. So going forward, the market does hold a lot of promise. The economy holds a lot of promise. Which brings me to my next fundamental dilemma. So we have seen that markets have actually picked up. Okay, the markets have seen an uptick. Okay, now this could obviously be as a result of a combination of factors. Maybe some amount of anticipation, a great amount of liquidity, a great deal of infusion through foreign investors. a lot of support by the central banks. Okay, so these could be the key attributes that have contributed. But at the same time, earnings have not really picked pace as yet. Okay, so earnings is a problem that we have been battling and talking about since almost many years now, and just as we're on the verge of solving, seeing some good earnings pick up. ILNFS happened the moment we started recovering from that and started seeing some more broad-based earning recovery. Then COVID happened. Okay, so in a way, it may seem like the market and the economy is slightly disconnected, and maybe the markets are running ahead of the overall state of the economy. Do you agree that there is a dichotomy in the way the market and the economy is functioning today? And maybe sooner than later, either earnings will have to catch up, or maybe there would be a healthy cool down that we'll see in the market. I'm not talking about a correction as yet. Okay, I'm just talking about some more calibration and cool down to bring the markets and the economy at par. What's your reading on this situation?
So just as with the economy, as I said that you're almost back to where we were pre-pandemic, or we will probably be in the course of the next 2 or 3 months. I think the markets have probably also therefore come back to where they were at let's say the start of the year, or let's say towards the end of calendar year 2019. So basically, which essentially begs the question that look, what has changed? I mean, even let's say towards the end of 2019, while of course we as a house we were looking for probably a better calendar year 2020 and 21 compared to what we had seen in 2018-19 pre-pandemic. But even at that point in time, I mean, the economy was not really kind of in a tear, or it was not on fire or any such thing. It was a fairly subdued economy. We were in fact kind of moderating as far as GDP was concerned, from 5.5 to 4.5, and then the pre-COVID print was even 3.5% that we last saw. So I think the economy was in a bit of a you know decelerating mode even then. But yet at that point in time too, the markets were at perched somewhere from a valuation standpoint. Let's say, I think if I recollect right, we were still around the 24, 25 times mark on a trailing Nifty multiple, and probably we were looking at somewhere around the 12 to 15% growth expectation going into the next 2 years on a CAGR basis. And here we are once again. I mean, we are at 25 multiple, and we are probably at an economic level, which is probably this by and large going to be where we were some while back. And I think yes, some things have changed probably as a result of the pandemic. Some good number of things have changed as a result of the pandemic in different industries and consumer behavior and so on and so forth. By and large, I think markets were where they were when they started off, and it's in it's congruous to the economic structure that we had in that point in time. Arguably, some of the things have got a little better for the economy, and there are some things which have even probably worsened a little bit compared. So, for example, if you look at good demand and improvement in tier two, tier three, it's as strong as what it was probably pre-pandemic, because last year too we had a good monsoon. We got another one even in calendar year 20. We got two good back-to-back monsoons, and we were kind of getting into 2020 with an expectation that the rural markets in India, or the Bharat of India, will probably drive or keep up the economy quite fine. And here we are again relying on that, and that continues doesn't disappoint us. I mean, it continues to give us that backup or the support that we need. Meanwhile, what has also happened, another good thing which has happened actually is interest rates have continued to head down. So if you look at pre-pandemic, we were at a repo of around 5.15. We are now at about 4. And more importantly, you know, uh, transmission of rates, which was actually not happening up until even end of 2019, has started to actually happen much more during the pandemic phase. So in this last 150 basis point reduction of repo rates, uh, a good part of it has actually got transmitted into the system, which was probably not the case when repo rates actually declined from 6.5 to 5.15 in the first phase. So I think we are seeing much better transmission. This is a time when we've got inflation somewhere around 6.5%, and rates at around a repo at around 4%. So we've actually got real negative interest rates after a very long time in India. I would like to think that as the food inflation subsides in the coming quarter, so uh, uh, inflation, overall inflation, headline inflation should also trend lower, and that probably should mean that we can continue on this bit of lower interest rate regime for a longer period of time. Maybe we may not see a large amount of interest rate cuts from here, but I think India probably can see a scenario or a period of relatively lower interest rates in its history after a very very long period of time. Many of the businesses over the last a couple of decades have always complained that India has got very structurally high interest rates, and not just with respect to the developed world, but even with respect to many of the other emerging market economies. So I think here we are, where interest rates are a lot more reasonable, and that at one level should not only support the consumption or any other investments, it also should obviously support valuations and what you look at it from a market standpoint. So these are a couple of the things which are actually got better compared to even the 2019 or pre-pandemic. Post-pandemic, of course, we've got a few other challenges that are we have a slightly higher crunch on the fiscal compared to what we probably had earlier. And on both counts, one is of course the whatever to whatever extent we have to support the economy, and also coming out of the fact that the economic activity being lower has led to lower tax shortfalls, lower tax collections, and along with which our very ambitious PSU disinvestment program has actually taken a little bit of a backseat. So keeping all this in mind, we will have a stretched fiscal, but it's at the same time also fairly well compensated by the kind of improvement that we've seen on the current account. And as you know, we are high up as far as our forex reserves are concerned, the highest level ever in a very long period of time, and we've continuously only moved up to now closer to 550 odd billion dollars. So I think that's that's supportive of the overall economy. I think, and along with that, as we have highlighted even in our market outlook recently, that uh, there is a good amount of new reforms which are being initiated by the government. They're not necessarily new, but things which were actually a little bit on the back burner have now received fresh attention. And they are very critical reforms, everything from education to labor to agriculture. May not necessarily have immediate ramifications on numbers or GDP growth or earnings immediately, but I think these are things which are fundamental bedrocks of the economy and which have needed addressing for a very long period of time, which are now coming into focus. So that's a very good thing to happen. So I think we're still in the process of the country of putting in some of the important building blocks in place. We did a good number of things in the last 2 3 years, whether it is with regard to taxation laws or whether it is with regard to uh, 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 social matters and so on and so forth. So I think we've done a fair bit in that regard, and that reform process is now once again receiving fresh attention, fresh focus. So I think all this at some point in time should also add up positively. They can't be counted and can't be accounted for at this stage, but as someone has said that everything that counts need not get counted, and everything that's probably counted need not necessarily count. So I think we have to take the mix and match of blend of both these things together.
Right, right. I feel that is quite an elaboration. In fact, I was following every line and I realized this is exactly the way an investor should look at the developing economics. In fact, I'll just take a shot at summarizing it for our investors, okay, who might have, found it difficult to follow you
I
through
don't
on.
know, but I just spoke a little too long, Ran.
It's absolutely fine. In fact, it
Probably a
wasn't long
long-winded
enough.
answer to a very short question.
I mean, you call it long, I call it insightful. So,
Thank you.
I'll just take a shot at summarizing it. See, the primary concern that investors have that the valuations might look a tad bit too rich. Certain investors would be looking at long-term averages and the PE ratios of at least bellwether indices would be looking a tad bit rich. Maybe trading at a 20% premium or so from the long-term average, but what like you rightly said, what people often miss out on is cross referencing it with the interest rate situation and the ROE situation at hand, right? Looking at only P ratios in isolation would perhaps be foolhardy at best, for the lack of a better word. So we are also at historically very low interest rates, and like you said, India always had this challenge of having structurally high interest rates, which is now not a problem, at least for some time. And I believe that the central bank does have some fiscal headroom to continue the like you rightly said, we have the sort of appetite to continue a lower interest rate regime, which will supposedly kickstart the entire consumption and investment cycle. I'm not sure, but maybe lowering commodity prices could also be a good input to support the entire consumption cycle. And last but not the least, you made a very important point. This is perhaps just the beginning of a full-fledged recovery cycle. The worst is perhaps behind us, right? So Tyre, is this a good way to summarize it, or have I missed out on
There are a
any?
couple of there are also a couple of other dimensions. So the other problem that one thing that is still not necessarily going in the right direction for us is the whole scenario around credit growth and appetite for credit. Actually, even though interest rates are now coming off pretty meaningfully, I'm just hoping that these interest rates, this lower regime of interest rates, somewhere down the line will actually trigger consumption and investments as well. Because ultimately, not just in India, but central bankers around the world are actually engaged in this exercise of making money cheap enough for it to kind of start appealing for real investment. I mean, you and me would probably, they are trying to essentially desist people like you and me from holding money into the banks, either putting it to some productive work or probably consuming. So I think today in India, unfortunately, we still are in a situation where credit growth is not necessarily moving up. It is, despite the fact that the monetary base, as a result of the stimuli, the quality support which is being provided by the government and the RBI, is rising, and yet credit growth in the system is not happening. And there is a still an element of risk aversion which has been prevailing for the last 3 or 4 years and probably continues even today to some extent. I think this will gradually recede. I think a bulk of the risk aversion was also because of the fact that banks in the country, large part of the banking system was uh, you know, uh, involved with this whole NPA stress. I think we are coming to the fag end of it. Some bit of that downward or that process of correcting the NPAs was already uh, by and large complete by the end of 2000. I mean, a good part of it had actually been achieved in the last 3 4 years. Unfortunately, it has got punctuated once again by the pandemic. On first assessment, it doesn't appear to be that it is as bad as what we all thought when we were sitting out in April and May. And as a result of things like moratoriums provided by the banking system and the situation around the economy and the lockdown, we felt that the stress on the banking system would be much higher. But it is not looking as bad as we sit out right now. And I would like to therefore think that some of those gains that we had made over the last 3 years in terms of our banks in the system having been able to overcome the NPA problem or make the necessary corrections, provide for it, raise money as and when required. That process is now once again going to help us to bring back credit growth along as we move into the next few years. The interesting part is that even during the last 4 5 months, many of our leading banks, whether it is an Axis, ICICI, HDFC Bank, and a few others, many of these who probably, to my mind, will account for the bulk of the lending as and when the growth in India gets stronger, are all very well capitalized. They've raised a good amount of money. They're sitting on very good reserves and capital adequacies on their balance sheets and are primed to be able to actually lend in whatever way they each of these feel comfortable in order to meet the credit demands or the credit requirements of the system at large. So I think we are in a good position. We on an aggregate basis. There are some positives. There are a good number of positives. There are some things that we need to work on, but we are in a good position. Uh, we are we are hoping to become a beneficiary of the whole China Plus One strategy as well. And I think some of our government programs which have been around, uh, in to support this over the last some years are now only gaining further momentum. Um, so I would like to think that that further can, add to another layer of growth, a missing layer of growth, which was manufacturing, which has unfortunately not been able to take off in the last some years. I think the next 4 5 years we can look forward to at least better outcomes. I would not like to go down the path of saying that we're all set to become the next manufacturing hub and all that. We have a long way to go from that perspective, but from our own reference point of where we were, and we've been struggling on manufacturing growth in the last nearly almost a decade now, and particularly in the last 6, 7 years, we stand a much better chance now in the next 5 years to be able to predict that. So these are some of the other dimensions which will count, and probably may not necessarily be visible, but markets in their own wisdom have actually, they markets are they think much beyond what you and me would think, and we know that markets are larger than all of us sitting out here, and we don't know. We would like to believe that they're just thinking about the next quarter or so, but the market in its collective wisdom, probably to our mind, is thinking about much longer outcomes out of the Indian economy and its potential compared to what we would like to do.
Right, right. Makes a lot of sense, Tahir. In fact, these other dimensions that you spoke about are, in fact, going to be very critical to the Indian economic recovery. You spoke about some very key sectors like financial services and manufacturing, and I couldn't help but realize even in Invesco's portfolios, I see a reflection of what you have said. The banks are, I can also see you, putting your money where you believe in, what you believe into, and a few good things that are going for the bank. Obviously, I acknowledge the prima facie problem that the broader money supply is pretty good, and the money multiplier in general is pretty good. But that could largely be attributed to stimulus. Credit offtake is yet not very impressive. But again, like you rightly said, asset quality recovery could be perhaps a longer cycle than initially anticipated. But also, once the moratorium data is coming in, the way the moratorium data is coming in, obviously in a very fragmented manner, but I can, make sense that it isn't looking as bad as yet. At least, it is showing some kind of promise. Maybe we, जो हिंदी में कहते हैं ना, दूध का जला छाछ भी फूक के पीता है. So, the moment the pandemic hit, we were all very, very worried about how would this shape up for the NBFCs and the banking segments. But I feel that the banks have really used this as an opportunity to capitalize themselves. We saw, like you rightly said, we saw a few private banks raise more capital and strengthening their books. At the same time, financial services will be key to bringing the country and the economic back onto its feet. So talking about financial services brings me to the next point. When, noticing a bit of let's say, I can see you favoring the sector a bit more than you used to. I'm talking about the IT sector. I can see IT becoming a good play. I can see IT. Is that the case? Mere coincidence? Is it right to observe that your outlook on IT is turning more positive as the days are passing?
Yes, so this was actually always a growth sector, as IT, and if you would have probably been around in the markets, and you would have observed the rise of the sector, especially in the late 90s and then through the early part of the 2000s. It was always a very important sector, and it was a growth-oriented sector. But as all kinds of businesses and industries, nothing goes and grows through the roof, uh, you know, uh, uh, on a continuous basis. There are industries, every industry goes through a certain cycle, and it reinvents itself. There are different new dynamics which come into play. Sometimes some of these new dynamics actually lead to a completely new growth. And I think that is what technology as a sector, or IT services for India as a sector, is probably undergoing. So after that first phenomenal phase of very low hanging growth, uh, led by Y2K and those kind of things, it is now the next phase of essentially adoption of uh, uh, digital services, and by a large section of the world economy, in several parts of the world economy. And therefore, IT services will play a center stage, will be center stage, and play an important role. They are reinventing themselves, and that growth drivers are now coming into place, whether it is digital cloudification and several automation and so on and so forth. So I think a new wave of, in our view, seems to have commenced. We've seen probably almost the last decade of kind of muted growth, more like single digits, or mid to high single digits of single digit growth for IT companies on an aggregate in India. I think my personal sense is that we will probably see an acceleration in that growth in the next 5 years, if not more, compared to what it has been in the prior years. And for which we've got some very interesting companies in the whole gamut of IT services in India. Most of these companies are very strong. They've got very strong balance sheets. They're all well regarded in the point of view of the management conduct or the promoter conduct. They're strong at return of capital. And they have all many of them have actually uh, uh, very clearly specified how they want to return the capital that they have on the balance sheet, either in the form of buybacks or dividends and so on. So I think they have nice, decent quality businesses which are available and which are not necessarily at extremely exotic valuations. Yes, the valuations have moved up in the more recent past, and they have got re-rated. But I think they're still kind of fair for the kind of growth. What is probably in the price is the 10 or 12 odd percent growth. But I think if at all this industry were to kind of accelerate in terms of growth, then that's not something which is very priced in by the market today.
Makes sense. That makes a whole lot of sense. In fact, while talking about IT, it reminded me that how can I have a discussion about IT without asking anything pertaining to the US, and especially when it's in the news for the upcoming election. So, do you have any reading on? See, honestly, I've been receiving a lot many notes and articles, okay, and I've seen all sorts of spurious correlations happening, okay. There are people drawing up charts of correlations between market performance whenever a Democrat wins, a Democrat rep wins, versus whenever a Republican rep wins, and all sorts of correlations happening, okay, within investor forums and also analyst forums, okay. At the heart of it, I feel, to a good degree, I treat it as spurious because it's going to be anybody's guess, and it's not like, all the dynamics are the same. But definitely from a policy standpoint and from a international trade relationship standpoint, it's going to make a whole lot of difference. Okay, the U.S. elections is going to make some significant difference to how India positions itself in global trade. For starters, then obviously it will trickle down into how the Indian markets perform. So, what is your take? What do you think is the extent of impact of the U.S. elections on the Indian market, and what are the key risks and the key opportunities that you can foresee at this juncture? Obviously, there's no clarity, but whatever you can foresee at this point in time.
So I'm not sure whether we have, at least sitting out here in India, we've got some great insights into the whole election-related phenomenon or the outcomes for the U.S. economy and maybe even the world economy. But yeah, we have some color, and we've all read about what uh, uh, the two parts of the two sides stand for in the U.S. I think in each of the cases there are certain things which are positive. There are some things which are positive in the other candidates' manifesto, if I were to call it, or their approach. So uh, uh, right now, from the point of view of the market, I mean, and the way we see it at Invesco, it's not as much about whether it is X or Y who eventually comes into power and wins the elections. It is about having a decisive election in the first instance. So the key word here is about having a decisive outcome. Markets, what they are priced in, probably markets are good. Probably it looks like, and it appears to me that the markets are good for any outcome, any of the sides coming into play. Because, like as I said, each of these sides has some advantages and certain aspects which are positive for the economy and not so positive for the other. So I think, but what is important, what is probably not priced in, or what the market can get maybe a little nastily surprised, is if it's an indecisive outcome or if it is actually an outcome which has a narrow difference and leads to a situation of a unclear election outcome or what they call as a contested election and so on and so forth. So if that kind of outcome materializes, then that's something which can create a little more volatility in the market than would probably to my mind happen if at all whether X gets elected or Y gets elected. But I think when we look at their individual policies, there are positives, like as I said, in some of them, and there are some other positives and some other. So But yes, I mean, given what has happened in the last 5 years, there are some expectations that it would not be a bad idea to have somebody who probably is a little less confrontationist, and probably for whom, as a result of whom, not just the US, but even the overall world economy is probably at a little has a slightly higher element of stability compared to what we have gone through now, perhaps in the last a few years. So. Uh, that may be an expectation which is there with, let's say, one of their candidates versus the other. So I think, barring that, I'm kind of I think in the US particularly, the way their economy today is configured, it doesn't look like it is in the very medium term. It's going to be significantly dependent upon the outcome of the election. It is the key risk, if at all, as we run with in the market today, is about policy risk, central bank policy risk. That probably will supersede any other risk, because the other risks will probably a little slow to come by, whether it is a policy of one particular president versus the other. That is going to kind of manifest and unfold itself over time, and not necessarily on day one after the elections are concluded. But monetary signals will probably act much faster and percolate down the markets much faster. I think that is where one needs to be watchful, although there's no cause for immediate concern, as based on indications which have been provided by most central bankers around the world, and especially the US. But if at all, as and when a larger risk materializes to this market, it will come out of policy risk.
Right, right. Um, Perfect. I feel this is what even investors should perceive, or rather take away from the ongoing fuss around U.S. elections. Obviously, as clarity emerges, we will also gain more clarity on who is sort of having an upper hand over the other, and what does he or she stand for, and what would the policies mean for India going forward. But obviously, that is something that we'll have to depend on time for. Perhaps time is the only entity that can answer it. In fact, talking about decisiveness, okay, so you said that the election should be decisive. Um, it took me back home, and I realized there is a lot of indecisiveness amongst investors regarding the small and mid cap category. And people in the past have been drawing up charts and sort of regressions and correlation analysis of how mid and small caps have always outperformed exponentially after every steep market correction. So like every steep market correction was followed by an explosive performance by the mid and small cap indices, broader indices as well. And that perhaps this wouldn't be any different, and people are actually hoping that mid and small caps will continue to drive explosive performance. However, at the same time, there is one faction of investors who are still concerned about the fact that every past correction was driven by a financial crisis. This time, it is not a financial crisis, but it is a health crisis, and the depth of the health crisis still remains unknown. And the most vulnerable to the health crisis is the balance sheets of mid and small cap companies. So maybe the valuations may have gotten ahead of the business in mid and small cap segment, and maybe it might not be a smart idea to invest into mid and small cap indices right away. So I know for a fact that you have been known for picking very good stocks in mid and small caps, and perhaps it would be great if you could share your view on this. On how do you see the valuation adding up for small and mid cap stocks? Is it a great valuation, or is it a value trap in the making, or perhaps how do you want investors to perceive this situation, and how do you want investors to participate in the mid and small cap segment?
So while dealing with the mid and small cap segment, well, I mean, although it is at one level a very, very broad universe, uh, uh, but at the same time, I mean, you don't have a choice but to look at each individual business bottom up and by itself on a standalone basis. At a very broad level, again, mid and small cap investing is not necessarily only about uh, having that tailwind around mid and small caps, or uh, you know, uh, uh, and getting that lift on. the markets getting enamored by mid and small caps for your ideas to perform. I think yes, I mean for a broader universe of mid and small caps to perform, you need a better economic cycle, economic cycle, because many of these mid and small cap companies are largely geared towards the Indian economy, the Indian domestic economic cycle. Unlike in case of the large caps, which have a fair bit of businesses outside of India as well, a fair bit of business coming out of outside of India as well. So uh, we need probably a tailwind for all boats to get lifted as far as the mid and small cap segment is concerned. But it does. If that is not present, it doesn't mean that mid and small caps are not worth investing in. There are quite a number of companies in the mid and small cap space which have done exceedingly well, even in an environment over the last 5 years when growth has not been as strong or the overall economic environment has not been very supportive. And they all these, many of these who have performed have all performed on their own individual merit because they have done a few right things, either with regard to their business or the market segments that they are operating in, or with respect to their balance sheets and so on and so forth. There are a good number of cases where some of these stocks have done exceedingly well in a very very lean period. So I think it's at the end of the day, it is more about you know. Uh, Identifying those important, those strong business, those mid-sized companies which have a runway of growth, have a fairly decent management presence, and uh, 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 hunger for growth as well, and growth in the right manner without actually leveraging onto your balance sheets. So I think at one level it is about that, but somebody obviously who is wanting to make a have a broader participation in the mid and small cap range of stocks, then I think where we are today in terms of valuations, it is not very easy unless we've seen a very strong climb back of the mid and small cap stocks in the last 7 8 months. In fact, even more than the large cap index for that matter. So we are now back to a stage of valuations where you can't really take a call that okay, if nothing happens, even then I will be safe. We are not at those valuations anymore. We were probably maybe uh, sometime in the middle of the pandemic, or the last time around I saw this kind of a very beaten down valuation situation for mid and small caps was after the ILFS crisis in towards the end of 2018. But we are not at that situation anymore. Today, at which the valuations at which mid and small caps are trading, one needs to understand that from here on, for one to make modest returns, decent returns, we need a better economic cycle for the mid and small cap companies to perform on an aggregate. Uh, on an individual basis, of course, there can still be some gems which might come out, like they have come out even in the last 5 years, as I mentioned. And so the way we are approaching is not as much thinking about whether we will get a good economic cycle or not, but we are looking at individual strategies of individual businesses and their competitive positioning. And if we find that they are attractive and they make sense even from a valuation standpoint without overpaying, we are happy to bite into some of these mid and small caps, even in our large cap strategies. Forget our mid and small cap strategies, where in any case we have to buy mid and small caps. We don't have a choice. But even in other strategies which are multi-cap in nature, we are willing to go down the path of buying mid and small caps, uh, even at this stage. But it has to be reasonable as per our assessment of the thing. So it all comes down to your individual liking and your understanding of a business. From here on, it is not a stage where you can just buy anything and be okay because you're buying them at very very down valuations. Those days have gone by. Now you need to do a little more harder work to be able to think of getting better returns out of mid and small caps.
Right, right. Since we were talking about multi-cap and how a mix of small, mid, and large cap have come to point, it reminded me of another popular discussion. Okay, so as we come towards the fag end of our session, this could perhaps be the last question from my end before we pick a few from the audience. But there's a lot of talk around optimal diversification. Okay, so we know diversification is essential to a portfolio. Okay, but what is the flip side of diversification? Is it concentration or is it focus? And I also slightly recollect that you have just concluded with a new fund offer focusing on a very focused sort of a fund and a very focused approach. And perhaps bottom up is the approach, the underlying approach, wherein you focus a lot on the quality of stocks, and the sector is a derivative or an outcome of it. So, if you could shed some light upon, what is optimal, how should an investor look at optimal diversification, and should one look at a focused portfolio as a concentrated portfolio, because the word concentration has a certain negative connotation, or should we look at focus as a great strategy to play out? So, since you're managing a focused portfolio and the initial signs are looking really good, why don't you share your thoughts on diversification and focus?
So, Nirav, you're right that we were we recently concluded a very uh, important IPO, NFO rather, new fund offering in our scheme of things. We've launched a focus product which intends to invest in not more than nothing more than 20 stocks. It's a really concentrated high conviction strategy that we have come out with, and we have been happy to receive a very good response from our investors, stroke channel distributor partners. So basically, I think the conviction that we went in with is the fact that, look, we as a house essentially have like to run with compact strategies all along. I mean, all our existing portfolios also are relatively more compact compared to our competitors. I would like to think we don't operate with anything more than somewhere in the range of between 20 and 45, 40, 45 stocks is what we operate with. Uh, so I would like to think that most of our products are reasonably compact in any way, even otherwise, even today. And it brings in some very important advantages. It basically allows us, of course, to deal with reduce the whole uncertainties around the market, in the sense that you're dealing with you're reducing the number of variables which come into play when you're managing a portfolio, because the larger the number of companies are, particularly if they're spread out across different kinds of businesses, then you have many more variables to track. And as an investor, it is impossible, or as a fund manager, it is impossible for you to to point track all these variables and be on top of everything, and you have things which will go out of your control. So we think that running things in a nice compact manner probably reduces risk. In fact, reducing risk. It allows us to do a lot more due diligence, a lot more intensively. Uh, uh, you know, so it's much easier to deal with the overall outcomes. Uh, it is just about making sure that you own the right kind of businesses. I think investors fear focus strategies as a result of the fact that it's comprising of 20 stocks and or 30 stocks, and it doesn't give enough diversification. And I don't think there are a lot of theories and mathematics, and even otherwise, when we've looked at our own strategies and we've some of these high conviction strategies for a good number of years, we don't really think it has increased the level of risk in the portfolio at any the risk of the portfolio. See, we see risk and volatility differently. We see volatility is about daily fluctuation in stock price. That is something maybe with 20 stock or a 30 stock portfolio, you may have a little more of compared to a more diversified strategy. Uh, but if you can live through this volatility on a daily basis, I think from a risk standpoint, we don't worry as much, because risk is more fundamental in nature. Risk is about going wrong with a the understanding of a business altogether. And if that kind of a risk were to materialize, then well, of course, that is something which is going to be a lot more severe than the daily price volatility that one thinks of. So basically, I think investors generally confuse risk with volatility, and they are not necessarily the same. Is essentially my point. And I think if you are backed up by a reasonably strong investment process, like the way we have been running at our place for the last good number of years now, very very consistent, high conviction process. I think it is possible to manage that risk of having lower number of stocks quite easily. We don't really think we are afraid of taking high conviction bets with a 30 or 20 odd stock portfolio. Yes, it does perhaps maybe induce a little volatility, but beyond that, I don't really think if we manage the fundamentals well, if we think about the businesses well, and if we generally don't go down the path of taking undue risk from a fundamental standpoint, then I think then focus strategies are clearly the way out of this whole problem of underperformance, because a focus strategy when dealing with 20-30 stocks will obviously have a significant departure from its underlying index. And if that were to be the case, then you're mathematically, if you run the strategy well, there's just no way you can underperform, at least over a 3, 4, 5 year time frame. Maybe things can go a little haywire in a sort of 3 month, 6 month kind of period. But by and large, if you've taken nice, good, hygienic bets, and you've sat through, and you've played that with conviction, mathematically you will obviously outperform, because your size of bets is completely different from what the underlying index would have. So that's the positive side of it. I mean, we think that if we are backed by a strong process, then we don't need to really worry about concentration risk. In fact, diversification beyond a particular point is not necessarily shown to have thrown up any better results either.
Right, right. I think you made a very important point that diversification beyond a point may not necessarily lead to optimal returns, and also that focus has its own value. Just like in life, in business, even in investing, focus is a valuable attribute. So, from my end, we will just take a couple of questions from the audience. I see quite a number of questions, but guys, in the interest of time, I will just be picking a couple of them. So, one question is, Tahir, what is your view for the next 6 months, and do you think the polarization in the stock market will continue? So, I feel the question is more around the polarization in the broader market. Maybe the Nifty 15 and the Nifty 35 versus the next 50, sort of a polarization. Presuming that is what the audience is asking.
Well, I'd like to respond by saying that, look, in the first few months, or maybe for even some time in the recent past, we have seen polarization at times, and for periods of time, blocks of time, but it has not necessarily been the case all along. I mean, there has been introversion which has happened, and things have caught up. Even post-pandemic, like as I said, actually, the mid caps and small cap indices, the broader universe has actually done much better than even the large cap indices. I think I last saw the Nifty returns from the March 2020 lows being more like 40%, 38 odd percent, and the mid cap index had done something like 45%, and the small cap index had done something like 65%. So it probably doesn't kind of come to the view that there is polarization in the market. There was a phase of polarization, probably a little more in 2019, but it was probably not the case then before, when we talk about the period between 2016 and 2018. And, again, the broader markets did much better. The mid and small cap space did much better than probably the top 100 companies. Moreover, in the even the post-pandemic era, we have seen a very systematic recovery in the market. So, in the first phase, it was about companies which are going to survive, irrespective of uh, whether we survive or not. Also, markets were only thinking about companies where survivability was very, very assured. In the second phase, the markets then started to move to sectors where there was some visibility of earnings, probably not as great, but at least better than many other sectors, such as pharmaceuticals or technology and so on. And then the third phase of the markets movement, more after, let's say, July, August of 2020, the last 3 or 4 months, markets have actually started to think about companies where probably the growth certainty may not be there today, but and numbers may actually be depressed, but where there is a fair sense, or a fair chance of recovery coming about quarters later. So the market has moved from one sector to another, one part of the market to another, over the last, even in this phase of recovery from March 2020. So I think there's all, of course, in perfect hindsight, but I think the market has moved in a fairly systematic manner, in terms of its, the way it is unfolded in the last some time. So I wouldn't really say that it is a very kind of narrow market or concentrated market. The market is now getting that what we all have kind of probably seen maybe in the last 12 or 18 onwards.
Right, right. Makes sense. Next question, perhaps final for the day. Which are the sectors that will benefit in the first order as the economy recovers? Basically, they're trying to ask what is your view on, like, which are your favorite sectors? If you say India is going to recover, which are the first set of sectors that will stand to benefit?
So as things stand now, there are some things which are already recovering, and we have seen recoveries in many of these quite strong recoveries, and borne out by their performances in the June quarter and even some of the incoming results of the September quarter. So obviously, what we've seen up until now is that parts of let's say technology, etc., of course, has done exceedingly well on both counts, whether it is top line or operating earnings or cost control and so on and so forth. That's a sector which obviously has lent itself very fast to a recovery. I think the other sector that we will probably see very strong numbers out of and is is coming out quite or stacking up quite well is pharmaceuticals and healthcare also should probably, at least for this quarter, one would like to think that the recovery will be very strong. I think parts of the rural basket or the businesses which are geared towards the agrarian economy, whether it is fertilizers or whether it is agri products, etc., has done exceedingly well and has come back uh, quite vigorously compared to some of the others. I think that is probably known and it's very well recognized by the market as well. I think what is currently slow and still gradually coming is still just about trying to come back to its speed. Urban parts of the economy and businesses which are geared more towards the urban sectors are slower to recover. So everything to do with urban consumer discretionary and things around that is coming back a little more slowly. Of course, the whole financial sector is bearing the cross of the whole economy as such, everything included, whether it is industrials or consumer or whether it is oil and gas, everything at one level finally converges at the steps of the banks. And they will probably be the slowest to recover. But even there too, I think at least from a market standpoint, I would like to think that most of it is kind of played out. Like I said, that we've not seen the situation being as worse as what we all thought when we were sitting in March and April. So that's a fair but and many of these important banks and some of the even the non-banks, the premier non-banks in the country have also kind of the situation quite well. They have got significant amount of capital adequacy. Um, the tail risk out of the banking sector, in my view, is actually out of the way. Now it is about slow recovery, but probably this is something which is the next to come by in terms of the recovery process. Um, I think there are some other ancillary areas such as home improvement products or white goods, etc., which are probably also going to kind of slowly have not recovered with uh, that strong in intensity. That's something which, as urban centers also open up, will probably accelerate from here on. So uh, this is how we have seen the sequence. I mean, the market in a way, actually, the sectors which have performed will provide a very easy clue to be able to understand as to which are the sectors which will be ahead in the recovery and which probably will be, more back-ended and slower to recover.
Right. I really hope our viewers were taking notes. I'm so sorry, guys. I did not tell you guys, but you should have actually had your pen and paper in hand. I feel it was quite a treasure trove that Tahir opened up, while answering to this last question. So, Tahir, you definitely gave us much more than what we had asked for. You have given us a lot of insights. I really thank you for being on the show. Guys, I know there are a lot many questions that we haven't taken up. Please feel free to write them to research at fisdom.com. I will try and reach out to Tahir if his team or he is able to respond to a couple of them. We will pass it on forward to you. Or if not, Fisdom's research team will be more than glad to help you out, resolve your queries. So for the questions that have not taken up, please write to research@fisdom.com. Tahir, thanks a lot. It was a really insightful and valuable conversation. There is a lot to take away from this conversation. In fact, I feel I'm also going to go through the recording once again and make my own set of notes. So it was a lovely conversation, Tahir. Thank you for being with us. It was a pleasure having you.
Thanks once again, Fisdom, for having me. Thanks, Nirav, for this opportunity, and once again, thank you for the whole team. Thanks, audience, for participating on this show, and please take good care of yourselves and stay safe.
Thank you, Tahir. Guys, this was a great conversation with Tahir. Uh, I definitely recommend taking notes if you did not. The show was themed wise decisions, and Tahir has definitely thrown light on the key pointers that go into making really wise decisions at this point in time. We spoke a lot about how the economy is going to shape up. We spoke a lot about how the markets are going. We spoke a lot around how valuations are looking. Key takeaways for you guys are the worst is behind us, better days are ahead. The economy is really strengthening from the root level up. There are a few challenges, but nothing is actually throwing a spanner in the works. There are many critical reforms and many critical stimulus that the government is and the central bank is putting in place to aid the economic recovery, and we can expect the economic recovery to take place sooner than later. It is important that everyone sticks to financial prudence and everyone sticks to their financial plans. Take help from qualified advisors, take help from qualified consultants, and stick to your investment discipline. The valuations, the media and the social media in general, everyone may have their own share of opinions, but please do not get deviated. The markets look good, and in particular, there's nothing that a long-term investor must critically worry about. There is no structural defect. In fact, if nothing, there is some really robust undercurrent of a structural uptick that is being formed. So, guys, keep it up, keep it up, and slowly so for the rest, as a like I always say, don't forget to share this video with everyone you know. The more you share, the more you learn. So don't forget to like, share, and subscribe to our channel. And I promise the next conversation is going to be much, uh, at least equivalently or more intriguing than this one. Tahir was a phenomenal guest. He set the bar really high, but I'm going to ensure that we continue maintaining the momentum if can't up the ante. The next session is going to be very soon, most probably in the next week itself. Stay tuned. We'll keep you informed. So like, share, and subscribe, guys. Thank you. Stay invested.